I'd now like to introduce Mark Zeptner from Ramelius Resources. Mark is a mining engineer and is the MD of Ramelius Resources. He was educated in Western Australia at the School of Mines in Kalgoorlie and has more than 25 years' experience, including senior operational management positions with WMC and Goldfields Limited at their gold and nickel assets in Australia and offshore. He joined Ramelius as Chief Operating Officer in 2012, took up the reins as Chief Executive Officer in 2014 and was appointed Managing Director in July 2015. Thanks, Mark.
Thank you, Michael, and thank you to Diggers once again. Unfortunately, I don't have a $16 billion merger to announce or even a humorous musical industry-related joke, but I do have a nice little video, assuming that it works, so look out for that. On Ramelius, in recent years, I've had titles such as building a mid-tier gold producer, even ones like breaking into a Gallup, but the fact of the matter is that Ramelius has been an Australian gold growth story as much as anything, and it's this growth journey that I want to focus on this afternoon. The presentation does contain some forward-looking statements, and we do count on our in-house competent persons to provide reliable information upon which we build our mine plans. In terms of the corporate summary, you can see the robustness of our balance sheet with over $205 million in net cash, and our institutional shareholder representation is now up over 60%. We have additional broker coverage compared to what you would have seen previously also. In FY20, we produced 230,000 ounces, and we're pushing up towards 300,000 ounces this year with a midpoint of production guidance of 270,000 ounces. You see them listed there, and experienced and very hard working. One of my non-exec directors tells me that it's a very hard-working board. Unfortunately, and management team, unfortunately we're without our chairman of the last 2.5 years, who's based in Adelaide and has entered his retirement. FY20 was an exceptional year for Ramelius. I had record production, which in turn translated to record net profit after tax of $113.4 million, up some 400% on the previous year. Our share price performance, seen on the chart on the left, was best in class, and that's a classroom that includes very well respected and generally larger peers, some of which are on the same presentation session as this one. We doubled our fully franked dividend, in fact paid out $16 million a matter of a week and a half ago. And finally, we recently entered the ASX 200 index, arguably giving Ramelius a wider appeal across the generalist parts of the market. And with ASX 200 entry comes increased focus on safety and ESG. Safety is a given at Ramelius. It's not shown here, but our 12-month moving average TRIFR is just under 15. And whilst we recognise that's not quite at industry levels yet, the trend is downward, which is pleasing. Our business is strong, as I'll show with the numbers and with our balance sheet, and we have added a risk and sustainability committee at the board level recently. We are committed to our people, who in this current COVID-19 environment are even more critical to any business's success. We endeavour to be an integral part of the communities in which we operate, and we contribute both directly and indirectly to those communities. And we're also mindful of the need to minimise impact environmentally where we operate, and I've got an excellent example at our Greenfinch open pit near Edna May of that. I mentioned growth at the outset, and this is the growth I referred to. Production growth. You can see here by the yellow bars 21.5% year-on-year growth from 2015 through to 2020, with a further 17% growth forecast for this year. Excellent cost management over the same period, shown by the red line, which has varied minimally only 4% in a very tight range between $1,150 and $1,200 an ounce Aussie, has led obviously with increased gold prices to expanding margins. And those margins as I'll illustrate later, are some of the best in the ASX space at the moment. Growth in production has been accompanied by growth in resources and reserves. The resources are the bars or the columns, and the reserve is the black line. Now, this growth has accelerated particularly in recent years, but it has been driven by both exploration and acquisition. Might surprise some to learn that the split is roughly 50-50 between exploration and acquisition in terms of that growth. And these resources and reserves form the foundation of our 1.45 million ounce mine plan, with a high proportion, some 88%, coming from this high confidence material. Before I get to the mine plan, I'd like to touch on our FY21 outlook by quarter, because in this game you're only as good as your last quarter. Happy to report that last quarter Ramelius outperformed. We see a breakdown here by ore source. It's a much more consistent year in terms of production, between 65 and 70,000 ounces a quarter, as compared to comparatively when you looked at FY20, it was much more back-ended. You can see the outperformance in Q1, and the all-in sustaining cost will be announced later this month. Now, given we've set up a number of projects through FY20, it means that our capital spend for FY21 is significantly down, some $20 million compared to last year. The only number that has increased is exploration. We put that up by $5 million to $25 million, largely driven by our newly acquired Penny project. This will generate significant cash again this year. In fact, in the last 2 quarters, underlying cash has increased up by $123 million in those 2 quarters alone. In terms of our mine plan, we announced in June, it was up 34% on the mine plan we announced 12 months prior. And quite simply, Mount Magnet is in yellow, Penny is in the orange, which is associated and will be trucked into Mount Magnet, and blue represents Edna May and its satellites. The main contributors to the increase from the year prior have been the Eridanus open pit and underground, and the Penny project once again. You'll see that in FY22 there's a dip in production at Mount Magnet. The team's doing what they can to fill that gap, and our early opportunities appear to be extension of the Vivian mine, which has been operating for some 5 years now, or earlier production from Penny. Obviously, any or both of those come to fruition, then we'll be pushing up much closer to that 300,000 ounce target that we have. In terms of mine plan details, there's no shortage of detail. If you look at the full 8 years, years 6 to 8 is largely low-grade stocks, so they're higher cost ounces. So that if you look over the full 8 years, you have a midpoint all-in sustaining cost of $1,300 an ounce. If you take out the low-grade stocks and look at the first 5 years, you're back at our bread and butter $1,200 an ounce all-in sustaining cost. We've got all the key projects covered in terms of capital, and our exploration is planned to contribute to mine life extensions and deliver a rolling mine plan, which you see so often in the Australian gold space. We believe that this detail provides excellent visibility and predictability to the market that not everyone in our space can boast. On our project portfolio, we've heard the Tier 1. Yeah, we're in a highly sought-after jurisdiction. We'll all acknowledge that. We're in the best place to be mining gold. Our 2 production centres of Mount Magnet and Edna May are supplemented by generally higher grade remote sites. But in saying that, our operations are principally located close to regional centres, and we're also fortunate that they're generally close to haulage routes as well. We have significant, well-established infrastructure in place and operating well, and we're mainly talking about our processing facilities there. And where we're operating, we like to be involved, as I touched on earlier, in our local communities. On Mount Magnet, there's not much more to say other than the strap line. It keeps on delivering. It's a classic mining camp, 100 years of mining on and off, over 6 million ounces. The most interesting thing for me is that we are finding new ore bodies such as Eridanus, which is in the bottom left, which is only a matter of kilometres from the mill in the top centre. We have an efficiently run processing plant, which is the credit to the guys on site. And we're looking at the option of upscaling that from the current 2 million tonnes at the moment as one of the studies that we're looking to convert more of our resources to reserves. Further to the south at Edna May, the market would have seen that Edna May is up and running at full capacity again, and the numbers that it's producing are exceptional. The underground at Edna May and the Greenfinch open pit are in full production, and so is the Marda project some 170 kilometres to the north by road. Both Tampia 140k southwest and Symes 80k south come a little later in the mine plan. Again, the mill is running very efficiently at about 2.6 million tonnes per annum, and we do have the benefit at Edna May of being on state grid power. Some quick updates on our projects. We're moving quickly to bring into production one of Australia's highest grade underground gold mines at Penny. Completed the takeover in 5 months, completed a PFS in 3 months, and Duncan Cootes tells me that we'll complete the feasibility study by the end of this month. We are looking at a 15 gram per tonne resource grade, a similar reserve grade. It's driven largely by the Penny North ore body, which is the one on the right in the section, and I'll just point out that the magenta blocks are plus 20 grams. Importantly, at Penny, we just recommenced after a break for COVID reasons. Exploration back at Penny, we're looking for extensions to Penny North and Penny West, which is the original ore body you can see on the left, and also looking for repetitions of Penny North further to the right or to the north. At Eridanus, we've got 500,000 ounces in resources there. It's the third largest endowment at Mount Magnet behind Hill 50 and Morning Star. We had an excellent experience with the Stage 1 pit in the centre of the photo, such that we've commenced the Stage 2 pit in June. Everything is going very well, and what you don't see on this slide is the fact that the ore body gets wider and higher grade with depth. We've got a deeper underground drilling program to probe depths below the depth of the design of the Stage 2 pit, which is 230 metres, down to plus 400 metres, with a view of having a bulk underground option for the years when the open pit is finished, which is FY 23-24 onwards. At Greenfinch, after much consternation and environmental permitting delays, which we could never really understand, when you look at the Greenfinch pit, it virtually touches the Stage 2 pit, the original Edna May pit up at the top of the photo. So we wondered why it would take so long when it's basically abutting an existing operation. We got there in the end. Our resource modelling is again standing us in good stead. Our models are reconciling very well. We're about 5 metres ahead, so our productivity is actually up. And this is the one I mentioned earlier in terms of minimising environmental damage. There's not one tree that hasn't been knocked over that didn't need to be, and we've got a situation where generally between the pit crest, I'm not sure if the pointer will work, this might be a risk, the pit crest here and the abandonment bun, a lot of places you'll see that area cleared. Obviously not here at Greenfinch, we're trying to keep as much of the natural vegetation in place as possible. A little further south down at Tampia, we're getting on with the longer lead capital items. The ore will be processed at Edna May, and we're installing some vibrating screens and putting in a leach thickener. You can see the photos on the right. In terms of approvals, we are continuing negotiations with the landowners, and we've already started the statutory approvals processes, being the mining proposal and the project management plan. We're working with the Shires, and we'll be upgrading some certain intersections between the Tampia project and Edna May once we have those agreements in place with the Shires. And there's a whole raft of work going on around the camp, which will be based at Narrabeen, and the contracts, both mining and ore haulage. And we're obviously keen to get Tampia into our production profile as scheduled, which is in FY 22, the start of production. Now at Marda, things are in full swing, and the best way to show you this is via a short video. So despite a great year in FY20, what makes Ramelius still a good investment? Well, it's things like organic growth and conversion of existing resources to add ounces to the mine plan not currently included. You would have seen we had 1.1 million ounces of reserves and 4.7 million ounces of resources. That's a conversion rate of 23%, lower than we all would like. And through FY21, we've got a number of studies here at Mount Magnet, underground open pit mill studies, to convert some of those resources that I suppose are sitting on what you could arguably call a lazy resource sheet. But we've resourced up in terms of having mine planning, resource geology teams be resourced up to be able to convert those resources. Obviously in a high gold price environment helps. At Edna May, the ore body there, the nature of that ore body is a large lower grade gneiss with high grade lodes within. So that does provide opportunities or various mining options, and we're running the numbers on which is the best option, whether it's a high grade underground that we're doing at the moment or a more bulky underground or even a stage 3 open pit. And in terms of inorganic growth or M&A growth, we've got a history here of adding value, and this is probably my favourite slide. Thanks Tim Manners, CFO, for this one. We've had a history going right back to the Coogee project in 2012 of adding value. The chart shows the acquisition cost in blue, the cash generated in yellow, and the net cash being the red dot. We have some excellent returns there, as we can see, and we're still enjoying Vivian, Edna May and Marda being in production, with Champion Penny obviously being in development phase. And whilst the investments are getting larger as you move to the right, I'd like to think that the returns are also getting larger here. And obviously with our balance sheet, we remain in a great position to be able to move as and when those opportunities arise. And just to finish off, I'd like to dispel any notion that Ramelius, FY20 anyway, is a high-cost producer. These two bars, the green is EBITDA margin and the yellow is underlying NPAT margin. And in FY20 at 56%, Ramelius had the highest EBITDA margin amongst a very well-respected peer group, and is not too shabby on underlying NPAT margin also. So come and see the team down at booth 19. Up on the left-hand corner, I thought it was where the water fridge was, so everyone would know where that is generally. It's on the other side, actually. They've moved the fridge, but come down and see the team. We've got the full contingent. We've got geos there who can answer any of those types of questions, and come down and have a chat to the team. Thank you very much.
Thanks so much, Mark, for that presentation. Yeah, come and sit back down over here, I guess, and for everything you've achieved with Ramelius, and nice to see it so profitable in such a difficult business. Love to have a question from the audience. If
folks, lunch is now served. Lunch is now served.
While the audience is thinking about that, wondering a little bit about your share registry, Mark. Is there who are your good supporters on the share registry, and what have they been up to recently?
Our number one shareholder is actually a group called Ruffer out of London, and I'm happy to say that the Australian institutional space has come to the party probably in the last 12 months. They were conspicuous by their absence prior to that, but we do have some offshore support, and we probably have, and it's the nature of the beast nowadays, we have more passive and quant and ETF type funds in that than actives. But it's something that's a work in progress. You go back 3 or 4 years and we were 100% retail stock. So it's a work in progress and it's coming along nicely.
Thank you. From the audience? And what do you think, Mark, your biggest challenge might be over the next year or 3?
I'm not sure if the Premier's still here, but if the borders stay locked down for an extended period of time, we've already heard about pipelines of growth, new projects starting up. We've got new projects that we'd like to start up. I think people are going to become a real issue, especially into FY21. And we've shown with our assets, and they're not the tier one assets, I'll acknowledge that, but we've got a great team that can really sweat the assets that we have, so it just shows the importance of your people, and I think that's going to become the biggest issue. The longer borders are locked down and access to people is restricted.
And I don't know if you feel like commenting on this, but how do you feel about your valuation relative to your peers out there in the marketplace?
Oh, we're horribly cheap, you know. That's a Dorothy Dix. I like that. Look, we've actually made some inroads in recent times. You know, it's you only have to go back not that long ago, and we were had to answer questions about what's wrong. You know, why are you so cheap? I think there's still a valuation gap there, and we're trying to fill that space in behind the Saracens and the Northern Stars, and I think we're putting a good case forward to do that.
You mentioned a bit of a comment that there's perhaps people have the perception that you've got a high cost of production.
Yeah, one of the interesting things in the market is that assets, rightly or wrongly, or good or bad, attain a perception that's really hard to change. And Mount Magnet and Edna May were seen as like high-cost, tough assets. Well, the numbers suggest that we've got them operating very competitively. And conversely, a good asset, once it gets a name as a good asset, it has to do a lot wrong to lose that reputation.
And further growth from where you are at the moment?
Yeah, we've got a stated target of 300,000 ounces. We think that's 3 production centres. We possibly get there with what we got, or a bolt-on, which is trucked into one of the existing production centres. So we're on the lookout, but we're in no rush. There's no immediate need to do that. So we'll take our time and back our DD to ensure that we get a return out of any move that we do make.
Thanks, Mark. Any thoughts out there? On that note, we'll wrap it up, and thank you very much for coming along and presenting at Diggers Deals today. Much appreciated.
Thank you, Michael.